Hello everyone, I hope you guys are doing well and studies going in full swing. In today's video, we will be tackling a very tricky standard, Ind AS 19, that is on employee benefits in your CA final FR, along with the important questions. So this is a standard on employee benefits which was earlier covered in your CA Inter under the new syllabus of AS 15. This covers all types of employee benefits, salaries, wages, provident fund, pension, everything except for share-based payments, because they are covered under Ind AS 102 on share-based payment. Every other legal or even constructive obligations, like let us say Diwali bonus, will be covered over here. Now, there are four specific subcategories for this employee benefits. First, there is something called as short-term benefits. Now, these are benefits which are payable in less than 12 months, and as a result, the effect of time is not material, and hence we will record them on an undiscounted basis, no separate present valuation to be done. Examples for this can include something like salaries, wages, bonus, etc., or important being paid leaves. This is short-term benefits. Next, you go to the most important part, which is the post-employment benefits, which is benefits which are payable at or after retirement. Something like gratuity, pension, provident fund, all of these are considered to be post-employment benefits. Third is termination benefits, and benefits like VRS or entrenchment are actually paid at the time of a forced retirement. Like gratuity was always planned, PF was always planned, but a VRS or a retrenchment, you are suddenly terminating employment and you are paying, that is what is called as termination benefits. And the last one is called as other long-term benefits. Now this is a very simple thing, everything which is not covered in the earlier three criteria will be covered over here, and hence this is other long-term benefits. Something like a jubilee bonus can be covered over here. Now, how is the accounting done for short-term benefits? Something like salaries, wages, etc. You will account for them as and when service is rendered. Very simple, you have been doing this in CA Foundation. For bonus, it depends on the type of bonus. Like if it is performance bonus, you will be recording when it is declared. If it is retention bonus, when the retention period is over, or if it is a constructive bonus like a Diwali bonus, when the event that gives rise to the bonus like Diwali goes by. Now, basically, you'll record for bonus as well as profit sharing plans when the obligation to pay bonus kind of arises. Now, the most important thing in my opinion for the short-term benefits is compensated absences, also called as paid leaves. Now, paid leaves can be further subdivided into two categories, which is vested, that is you can claim an encashment, or non-vested, in which case encashment cannot be claimed. So, when you look at vested benefits, these are benefits where encashment can be claimed, which means whether you can carry it forward or you cannot carry it forward, it does not matter. Whatever is the unutilized leave, you will directly create a provision. Like you are an employee with a salary of 100 per month, 30 days is your entitlement, and you have not taken any leave, in which case for the entire 30 days you will create a provision in case of vested benefits, because even if you can carry it forward or you cannot carry it forward, you will get an encashment, and hence the provision is to create it for the entire 30. Leave salary account debit to provision for leave salary. However, when it is non-vested benefits, so this is a chart, let us say for non-vested benefits, you have to further see whether it is accumulating, that is can you carry it forward, or it is non-accumulating, that is it will lapse if not utilized. If it is non-accumulating, again you cannot carry it forward, you cannot even encash it, which means this will be ignored. If you have worked for the entire year and not claimed your 30 days, you cannot utilize it in the next year. You can't even claim an encashment, and hence there is no further expense. So over here there will be no provision for unutilized leaves. On the other hand, the most tricky part over here is if it is accumulating leaves which are non-vested, like you can carry it forward, in which case if there are 30 days that you have not utilized but you can utilize it in the next year, in which case you will create a provision ideally for the unutilized leaves of 30 days. However, in your past experience you believe that the employee will maximum take 15 days of leave. Then the standard says in the next year what you are going to pay is only for 15 days, and hence it makes sense to create a provision only for the unutilized leaves to the extent they are going to be utilized. Like if it is a 100 per month salary and you are expecting only 15 days to be utilized in the next year, in which case 100 into 15 by 30, that is you will create a provision, let us say of 50 rupees. So provision should be made for unutilized leaves to the extent they are expected to be utilized. Institute can possibly ask you questions regarding this. Simple summary would be vested benefits, that is you can encash, you create a provision whether you can carry it forward or not for the entire amount of unutilized leaves. For non-vested benefits, you create a provision for leaves which can be carried forward to the extent they can be carried forward and utilized. For leaves which cannot be carried forward, no provision to be created. Okay, next you go to post-employment plans. There are two types of plans. First, there is something called as a defined contribution plan, where the amount of contribution to be paid is defined. Like if I were to contribute money to the government's PF office or a group mediclaim plan, the amount of contribution is defined. Beyond that, the employer has no liability, in which case you will create a provision only to the extent of the contribution. You don't need to estimate the overall liability, because the actuarial risk, that is the risk of the liability, or investment risk, that is the risk of plan assets, is not on the employer, it is on someone else. So I don't really need to care what the plan assets or plan liabilities are. I will directly record an expense for the contribution amount. No separate complex calculations needed. However, when you look at a defined benefit plan, here, irrespective of the contribution, the benefit, that is the amount that you are going to pay, the plan formula, that is defined. So when you look at a defined benefit plan, something like a gratuity, in which case you might have estimated a particular last drawn salary and maybe created a sinking fund to make that payment. But even if the employee's last drawn salary is different, you have to pay based on what the employee's last drawn salary actually is. So you cannot say that merely because I was contributing 100 rupees, I will pay you that only. No, the benefit is defined irrespective of the contribution, in which case the risk of the change in liability or a possible shortfall in investment rests on the employer, in which case you will have to project the liability, figure out the plan assets, do the working by a method called as projected unit credit method. If you can do it yourself, nothing like it. Otherwise, you can take the services of an actuary for this, which is also recommended. Now, if for a theory perspective, not very important, there are certain types of plans, like a state plan, which is run by the government, is typically defined contribution plan because the risk is borne by the government. Multi-employer plan, like a mutual fund, typically is, it depends on the terms of the plan. However, if nothing is given, then we can say that this is a defined contribution plan. Then there is a group benefit plan, like for Tata Group, there are various group companies for which you have created a plan. This is also going to be usually a defined benefit plan because the risk is usually within the group. And last is insured plans, where you usually take a policy from the insurance company and thereby the risk is usually borne by the insurance company, where it is a defined contribution one. From an exam perspective, not very important, but probably if it comes in an MCQ, you should be aware. Now, probably one of the most important things that you should know about this chapter is the accounting for a defined benefit plan, and more so the presentation for the same. So when you look at the defined benefit plan, at least the accounting aspect, you will try to look at a few key terms while you are measuring the defined benefit liability. We have taken a fairly decent example over here. It's a simplified example. If you want, you can pause and kind of glance through the example. This is a case where there's an employee who has joined the company and he has been told that he will be paid 1/2 into the last one salary into completed years. So at the time of his retirement. So this is a defined benefit plan. Actuary has made assumption of last one salary at 10,000, years of service as 5 years, out of which 1 year is served, 4 years are remaining, and 10% to be the discount rate. Considering this, if I want to find the amount of liability, I will say that when should I recognize a liability? Earlier, before the standard, people would say, I don't know how many years the employees will stay, what will be the salary when they leave, and hence they used to wait till 5 years, and hence the entire accounting would happen in the 5th year. But is that fundamentally right? No. It breaches the concept of accrual as well as matching concept. You should recognize the expenses as and when they are incurred and not when they are paid. In this case, this expense is incurred as and when the employee renders service. So over here, for the first year of service, we can say 1/2 into the last one salary, that is 10,000, into completed years, that is 1, and as a result 5,000 is the amount. 5,000 we can say is the amount of benefit attributable to each year of service. For each year of service, 5,000 will be attributed. So when the employee renders the first year of service, one can say that a benefit of 5,000 is accrued, though it will be due when you actually retire, but it is accrued because you have rendered the service. And hence for this 5,000 rupees, you should create an expense. This accrued because of the service that was rendered, and hence this is called as current service cost. Now the problem is, even if this accrues in the first year, it is not payable in the first year, it is payable at the end of the 5th year. That is, it is 4 years away from the end of the first year, and hence we will say that 5,000 to be paid after, let us say, 4 years is equivalent to how much today, and you find the present value, which comes to around 3,415. So your entry will be EB account debit in the form of current service cost to, let us say, provision at 3,415. So at the end of the year, your provision will appear at 3,415. Now in the next year, there will be further 1 year of service rendered, and hence there will be another 5,000 of benefit which is entitled at the end of the second year. However, this is going to be paid 3 years later, and hence you will try to find the present value, which comes to approximately 755. So we will say 5,000 is due to be paid from the end of the second year 3 years later, that is at the end of the fifth year, and hence the present value for the same will be around 3755. Now you will again recognize this as current service cost in each of the years. However, the problem is when you recognize current service cost of each year, that is perfect, that is linked to each year of service. However, the opening balance that was 3415, because of the passage of time, comes 1 year closer. From year 1 it goes to year 2, then year 2 to year 3, and hence there is some interest costs as well. Remember, interest cost is linked to passage of time and not necessarily the service that you rendered, and hence you will try to calculate the interest cost. Interest cost will be the opening balance, let us say, into the EIR. That will be, let us say, your interest cost to be recorded. So over here, this will give you, let us say, workings for each of the year for interest cost as well as current service costs, and ultimately you will land up to the amount that was to be paid. And once you paid, this is provision account debit to bank, no further expense. Expenses would be recorded over 5 years rather than getting recorded at the end of the fifth year. Where will the current service cost go? Well, in the P&L. Where will the interest cost go? Well, in the P&L. Now the problem is, in all of these workings, we are saying that the assumptions remain the same, but that is not generally the case. It is very much possible that actuary can keep on changing the assumptions. Like the actuary might say that instead of expecting a last drawn salary of 10,000, the employees will actually get a last drawn salary of 15,000, in which case the value of liability will change. So you might say that the liability, let us say, ideally should have been around 12,000. However, the liability actually comes up to 18,000 because now the last drawn salary estimate is increased. Now that increase of 6,000 is attributable to assumptions that the actuary has changed. This will go into something called as remeasurement reserve, which is a part of other comprehensive income, non-reclassifiable, which means on the happening of certain events like the benefits being paid to the employee, the balance in the remeasurement reserve will be transferred to retained earnings and not to the statement of P&L. So over here you will transfer the this is actuarial gains or losses to the remeasurement reserve, which is a part of other comprehensive income. Now how do you calculate this? Usually in almost every institute problem, we usually calculate this as a balancing figure. That is, you will take the opening balance, add current service costs, interest costs, do all the adjustments, come down to the closing balance. If the closing balance and the statement does not tally, the difference is because you have used different actuarial assumptions, and hence that will be adjusted against other comprehensive income. Now sometimes the institute might want you to give a disclosure, a breakdown in this other comprehensive income, actuarial gains or losses. Breakdown can be given for 3 parts: changes due to demographic factors like mortality assumptions, changes due to financial assumptions like inflation, interest rate, or changes due to experience variance, like what the actuary expected versus what actually happened was actually different. So if data is given, then you will also show the breakup between this. It was given, I think, in May 23 RTP or something, but otherwise usually this data is not given in an exam question. In practice you can see this from the actuarial certificate. Important thing is, whatever is a change in actuarial assumption should go through the OCI, because the institute believes that actuary can keep on changing the assumptions, and as a result it is not appropriate to take everything through the profit and loss account. You will adjust it accordingly to the OCI. One year actuary might increase the assumption, other year it might decrease. So let those effects go in the OCI rather than making your P&L volatile for the same. Okay, next there is something called as past service cost. Now when actuarial assumptions changes, these assumptions, this is not the plan. A change in any of these assumptions can be treated as changes in actuarial assumption. But if the entity amends this plan itself, so rather than 1/2 into last drawn salary, entity says I'll pay you or let's say 3/4 on the last drawn salary. That is, it increases the benefit. Or I'll just pay you 1/4 on the last drawn salary. That it curtails or reduces the benefits. This is not a change in assumption. It is an actual change in plan, an actual change in fact. In such a case, my liability will change. Earlier my liability was measured using 1/2 into last drawn salary, but in the 4th year, if I were to change the plan to 3/4 into last drawn salary, probably the 4th year's current service cost may be based on the revised formula, but the older service cost was based on the 1/2 formula, and as a result any additional cost that you have to pay is called as the past service cost, and past service cost is to be taken to the profit and loss, not to other comprehensive income, because it is a change in fact, not a change in assumption. Past service cost is usually when you have to pay more, whereas curtailment is usually when you curtail the benefits and usually you have to pay less. Like you might change from 1/2 into last drawn salary to 1/4 into last drawn salary. That is kind of a curtailment case. So in these cases, you will take the past service cost or the gain or loss due to curtailment, if any, into the profit and loss account. So among all of these, you need to remember that actual gains or losses will go to the remeasurement reserve. Everything else is going to be routed through the P&L. At the end, when benefits are paid, that reduces the liability, provision account debit to bank. There will be no separate effect in the P&L in general if your estimates were correct. Now this is usually the working when it comes to plan liabilities. Next, when you go to plan assets are assets which are earmarked, dedicated for meeting the plan liabilities. This may be investments in bonds, debentures, this may be qualified insurance policies. Usually assets are shown on the asset side of the balance sheet. However, these are earmarked dedicated assets for meeting the plan liabilities, and hence institute says that while presenting in the balance sheet, you will always show it as plan liabilities minus plan assets, and only the net amount, whether it is a liability in case of a deficit or a surplus in case of an asset, will have to be shown in the final balance sheet. Now the problem over here is, at what value will you measure these assets? The standard says they will always be measured at fair value. Why? Because when an entity has to make a contribution, they will look at the fair value of the assets and not amortized cost or cost. They will look at the fair value of the assets before they make the contribution, and as a result, over here, two things for plan assets. First, you will show it as net from liabilities, only the net amount will appear in the balance sheet. Secondly, only the fair value will be taken for the purpose of asset, and no other cost or amortized cost working is permitted over here. Okay, now what happens in case of a plan asset is, let us say your opening plan assets were 3,000 rupees. Why will these plan assets change? Well, during the year you might make further contribution, and hence your plan assets might increase due to the contributions, or during the year you might pay some benefits, in which case your plan assets will fall because of benefits are paid and plan assets are sold to make the benefit payment. However, since these plan assets are to be shown at fair value, during the year there can be changes in the value of the plan assets. Like for example, in the opening, plan assets was 3,000. During the year there was no contribution, there was no benefits paid, but at the end of the year, if I do the fair valuation let's say comes to 3,400, then what is the increase of 400 attributable to? It is not contribution, it is not benefits. Then probably we must have earned a return, an actual return, which comprises of interest, dividend, realized or unrealized gains, and actual return is to be considered over here. Now when we look at, let us say, an actual return, the journal entry over here is, this will increase your plan assets account debit to what? We will say it is a return, and hence return should go to the P&L. Now the problem over here is, if I take it to the P&L, in the P&L I will show it on the income side. So there are certain expenses, and then I will show an income, actual return on the P&L credit side, for example. Is that going to be appropriate? Well, possibly yes. However, one can say that plan assets was for meeting plan liabilities, and hence we deducted the plan assets to show the net amount. Like you do it for bad debts, provision for bad debts, you have debtors less provision for bad debts, net amount. So you reduce the plan assets from the liabilities to come at the net amount. In a similar way, can we say that the income on these plan assets will help us in reducing the expense, and as a result we will take the total expense minus the income that is earned from the plan assets, and only the net income is to be taken. So rather than showing the income separately on the credit side, you will actually show it as a deduction from these expenses that were recorded on the liability, and only the net amount will be shown. Now this could have been okay, but the institute makes it a little more complicated. It says that like actuarial gains or losses on liabilities, there can be a plus and minus gain or loss. In a similar way, when an actuary predicts the discount rate, he usually looks at the expected return on the plan assets. He said that what is the opportunity cost concept says that we are not paying the liability today, we will pay it in the future. But if we pay it in the future, we will earn time value. So where will we earn time value? We will deploy that money in a plan asset and earn a return. How much return? Well, on an average, 10%. This is not a return for a particular year. This is usually the average return over the life. Now, you look at actual interest rates. Maybe in some of the years, you might earn 12%, 11%. In some of the years, you might earn 8%, 9%. Average return actually says is going to be 10%. Now, the problem is, if I take my expected return on this 3,000, I would have earned 3,000 into 10%, that is equal to 300. That is what I expected. But during the current year, I actually earned 400. That is, I earned 100 more. This is the change in return. The standard believes that actually on an average expects that you are going to earn 10%. Maybe in one of the years you earned more, 100 more, but in one of the years you will earn less. And as a result, actually says that you should take the expected return into the P&L, and the changes in return, if any, will again go through the OCI. So if I look at the 400, out of this 400, we will say plan assets have to be debited. So your plan assets account debit, we will increase the plan assets by 400. That is what is the actual increase. Ideally, I will say to EBE, I will reduce the employee benefit expenses in the profit and loss account by the expected return, that is 300 rupees, and to remeasurement reserve, this is changes in return on plan assets of 100. So in the remeasurement reserve, 100 will go and 300 will be reduced from uh, uh, the EBE. So this is something that you have to be careful about. Then you go to the presentation in the balance sheet, where you have to present the net deficit or net surplus, that is liability minus asset, will be presented in the balance sheet subjected to the existence of an asset ceiling. Now this is rarest of the rare case. What is an asset ceiling? There is a withdrawal restriction. Like for example, you have 3,000 rupees of liabilities, but you have contributed 4,000 in plan assets, in which case there is a net 1,000 asset, which means after meeting the 3,000 liabilities, 1,000 technically can be used by the company whenever it or wherever it wants, provided there was no asset ceiling. If nothing is done, we will assume there is no asset ceiling. However, if the question specifically tells you that there is an asset ceiling of 300 in case of a surplus, it means that even if I have a net asset of 1,000 surplus, I can maximum use 300 rupees for withdrawing. The remaining 700 has to be used for employee welfare only. And hence in my balance sheet, I cannot show 3,000 minus 4,000, that is net 1,000 as asset. Because as on the balance sheet, I can maximum withdraw only 300 rupees. Which means, what about the remaining 700? We will say that this 700 is not technically a loss, because it is very much possible that for a going concern, in the next year, there is further current service costs, etc. And hence the liability goes from 3,000 to, let us say, 3,500, 4,000, 4,500, in which case you might not necessarily make more contributions on the plan assets. And hence, whatever is the 700 is not technically a loss, but it will be shown in the remeasurement reserve. So there are three things that will go in the remeasurement reserve. First is the actual gains or losses on plan liabilities. Second, changes in return on plan assets. And third, changes due to the effect of asset ceiling. Asset ceiling will only apply in those questions where you have a surplus and a separate asset ceiling is defined. So over here, you might have 200 rupees as surplus assets in this example. However, the asset ceiling is, let us say, 50 rupees. In which case we will say, for the remaining 150, I will reduce the assets and debit the remeasurement reserve. So this kind of takes care of the concept of asset ceiling, and in my opinion, the most important presentation or the section of this chapter is this summary, where we are saying that how will things change. So remember, from an actuarial valuation, we will say that opening liability as per actuarial valuation will appear, opening plan assets will appear. Why will the liability change? Well, it will change due to the interest cost. The second effect of interest goes to the P&L. It will change due to current service cost, the second effect of which will go to the P&L. It will go to change due to past service cost, whether it is vested or unvested, it does not really matter. The second effect of which will go to the P&L. It will change due to possible curtailment, again the gain or loss of which will go to the P&L. However, it can also change due to benefits paid, but where will you get the money for paying the benefits? Well, probably from the plan assets. Then closing actuarial valuation may be given. So why would the number be different? Because of changes in actuarial assumptions, the second effect of which will go in the remeasurement reserve. So this is reconciling the liability. Similarly, reconciling the assets. Assets will change due to expected return. Discounted is the same as the expected return, and the second effect of expected return will be reduced from the expense rather than taking it as income in the P&L. So this is the second effect. Then you have, let us say, contribution. So any money paid, contribution paid will go from the bank account, and then there is changes in return on the plan assets. These changes in return on plan assets will be affected against the other comprehensive income, or let us say the OCI. So this will give me, let us say, the total working for, let us say, the plan assets and let us say the plan liability. In my balance sheet, I will do plan liability minus plan assets. If there is a deficit, you will show it as a net liability. If there's a surplus, you will show it as net assets. However, if there's an asset ceiling, we will make certain adjustments to the asset ceiling in such a way that your amount cannot be shown beyond the asset ceiling in case of a surplus. There is a sum that we will also solve on this, but this is something which you have to be particularly clear on each of the double effects, where they are going, and accordingly get the expense to be recorded in the P&L, the changes in remeasurement reserve in the OCI, everything. This is kind of the crux, I would say, of Ind AS 19. Now, a few other cases in the question come regarding attribution of current service costs. How will you attribute current service costs? You will attribute current service costs, remember, when a year of service gives rise to additional unit of entitlement. And you will stop attributing current service costs when a year of service does not give you any further attribution. Like, for example, if I have a plan which tells me for employees which are having 25 years and above of age, for every year they work, I'll give them 140 rupees. If you are 22 years of age and you work for 1 year, then there is no attribution. Your 1 year of service does not give rise to any additional unit of entitlement, and hence you will not attribute any current service cost. However, when you cross 25 years of age, and now you render 1 year of service, then the 1 year of service that you have rendered will give rise to an additional unit of entitlement, and hence you will attribute current service cost. Till when can you continue attributing current service cost? Let us say you are told that employees between 25 years of age to 35 years of age will get 140 for each year of service when they actually retire. Now, if you are at 26 years of age, 27 years of age, every year of service gives rise to an additional unit of entitlement till the time you touch 35 years of age. After that, if you can still give service, when you turn 36, 37, 38, you can still keep on giving service. However, that additional unit of service does not give rise to any additional unit of entitlement, and as a result, you will stop attributing current service costs. So, you will attribute current service costs from the period when a year of service leads to benefit accrual and end on the period when further service does not give rise to any further benefit accrual. There may be certain questions where you might have a possibility that benefit accrual happens on a different basis, like for the first 10 years of service you are going to get 10%, that is 1% for every year of service, and if you render a further 10 years of service then you get another 40%. In which case the standard says that if service in the later years, that is from 11 to 20, gives rise to a materially higher level of benefit, like it does in this case. The first 10 years of service gives you only 10% of, let us say, medical cost reimbursement. If you render another 10 years, you will get another 40% medical cost reimbursement. So, we can safely say that if you are rendering service in the later years, this is giving rise to a materially higher level of benefit. If you are expected to, let us say, render service over 20-25 years, then we will say that we will spread this benefit on a straight line basis. That is, if I render service over 20 years, then I will get 50% of the medical cost as reimbursement, maybe 10% due to the first year, 10 years, maybe 40% due to the last 10 years. However, we will account it on a straight line basis, that is 20%, 50% divided by 20, that is 2.5% in each year. However, if it was twisted the other way around, that is, for the first 10 years of service you are getting 40%, for the next 10 years of service you are going to get only 10%, in which case the service in the later years does not give rise to a materially higher level of benefit, in which case the prescribed ratio is not a straight line ratio, in which case for each period you will record expenses proportionately, like in the first 10 years, 40% over the first 10 years, that is 4% in each year, 10% divided by 10 over the next 10 years, that is 11% over the next 10 years. Are we clear with this? So over here, if an employee service in later years gives rise to a materially higher, it does not say always you do straight line. If employee service in the later years gives rise to a materially higher level of benefit, then you will do a straight lining, otherwise you will do a proportionate pro rata allocation. Next, you have the last two types of benefits, that is other long-term benefits and termination benefits. Other long-term benefits tell you that the accounting is going to be exactly similar as post-employment benefits. However, there is no remeasurement reserve or OCI concept over here, which means if there is any actuarial gains or loss on liabilities or changes in return on plan assets or even the effects of asset ceiling, they will be taken to the statement of profit and loss. There is no OCI concept. So when you read the question, you have to be clear whether it is a post-employment question or other long-term benefit question. If it is a post-employment question, then there will be a remeasurement reserve that gets created. But if it is a other long-term benefit question, then this will not separately be created. The gain or loss over here will go to the profit and loss. The last part over here is termination benefits. You will recognize the termination benefit when the obligation to terminate arises. Like a VRS plan is launched and the scheme is approved, that is when you will recognize the termination benefit, when the obligation to terminate arises, not when it is paid, not necessarily when it is expected. You will record it when the obligation to terminate arises. Now a challenge over here can be that sometimes there may be a composite package where the employer tells you that I will pay you 10 lakhs for termination. However, if you continue for the next 10 months, I will pay you 30 lakhs. Now apparently this appears that 30 lakhs is also a compensation package because you are terminating. But that 30 lakhs is paid because you are rendering service over the next 10 months. So we will say that out of that 30 lakhs, even if you don't render any service over the next 10 months, you will still get 10 lakhs. So that is something which is directly attributable to termination, only 10 lakh rupees. The additional 20 lakhs are paid not because of termination, but because you are rendering additional 10 months of service, which will be recorded as an expense over the next 10 months. So only and only those benefits which are directly attributable to pure termination and not to service will be recorded as a termination cost. If it is linked to service, it will be recorded as service cost depending on whether it is short term, other long term, etc. This kind of by and large takes care of Ind AS 19 in around half an hour. Now, questions over here, I would say the most important question over here which you need to clearly get out of the way is this question. Institute loves asking you a question like this. So in this, what are you supposed to do? You are required to examine and present how the events would be reported in the financial statements of A for the year ended 31st March 18. So this is for the year 17-18 as per Ind AS. Now A prepares its financial statements up to 31st March each year. It operates a defined benefit. It's a defined benefit retirement plan. Retirement plan because it is post-employment. It is not other long-term benefits. On behalf of current and former employees, A receives advice from actuaries regarding contribution levels and overall liabilities of the plan to pay the benefits. Okay, so I'm taking the services of an actuary. On 1st April 2017, the actuaries advised that the present value of the defined benefit obligation was 6 crores. If I were to do this in lakhs, let us say 600 lakhs. What is this? So this is the opening balance of the liability. So over here, I can say that this 6 crores is an opening balance of the liability. Will I have to give two effects for this? No, it will just be an opening balance in the liability. On the same date, fair value of the defined benefit plan assets was 5 crore 20. What is this? This is the opening fair value of plan assets. There will be directly opening balances. So if I take 6 crores over here, if I take 5 crore 20, that's it. These are opening balances. On 1st April 17, the annual market yield on the bonds was 5%, which means the plan assets are expected to yield 5%. So 5% of, let us say, 5 crore 20 will be around 26 lakhs. So this is expected return. Actual return can be something else. So this will increase the plan assets, and the second effect will go, let us say, to the expense. You will reduce 26 lakhs from the expense. Further, the expected return on plan assets is nothing but the discount rate on plan liability. So if I plan liabilities is 6 crores, 6 crores into 5% will come to 30 lakhs. My liability will increase by 30 lakhs, and the second effect will go in my EBE, in the profit and loss account. So over here, I will say that this is interest on the liabilities. I will increase this by 30 lakhs. Second effect of this will go in the P&L as an expense. Interest on the plan assets is 26 lakhs, and I will reduce this because it is an income, so it will reduce the expense, and hence the net effect over here is going to come to 4 lakhs. Okay. So what I'm trying to do is, on these balances, I'm trying to calculate the return. Okay. Plan assets plus 26 lakhs, plan liabilities plus 30 lakhs. The second effect of this will go to the P&L. Interest expected will go to the P&L. Now during the year ended 31st March 18, A made contributions of 70 lakhs to the plan, and plan paid out benefits of 42 lakhs to the retired members. Can I say contributions made will increase the plan assets, and as a result I will increase the 70 lakhs in the plan assets working. The second effect goes against the company's bank account. It will not go to the P&L. So 70 lakhs will increase the plan assets. 42 lakhs is the benefits paid. Now, if benefits are actually paid, this will reduce my liability. But from where will I pay the benefits? Well, usually by selling plan assets, and hence this will also reduce my plan assets. So typically, plan liability account debit to bank, but the money for that, bank account debit to plan assets, and hence 42 lakhs will be reduced both from the plan assets and the plan liabilities. But the thought should cross your mind that when 70 lakhs of contributions are received during the year, like I earned 5% return on the 5 crore 20 at the start of the year, I will also ideally earn some return on these contributions depending on the date when these contributions are received. So if their contributions are received at the start of the year, I will earn a return for the entire 12 months. If they are received in the middle of the year, I will earn a return for 6 months. But if they are received at the end of the year, I will not earn any return. In this case, you have been told both these payments were made on 31st March, and as a result, there will be no separate adjustment of, let us say, interest on either of these. If they were received or paid somewhere before 31st March, you might have to do a separate adjustment for, let us say, the expected return as well for this. So let us say if they were made at the start of the year, then I would say I'm receiving 70 and I'm paying 42, which means I'm net receiving probably 28 lakhs. On this 28 lakhs as well, I will earn a 5% return. If this was received at the start of the year, if in the middle of the year, then into 6 by 12. In this case, at the end of the year, so net 28 lakhs you are receiving, but on the last day of the year, and hence there will be no separate income to be earned on them, at least in this year. So when I go to see where will the 70 lakhs go, we said it will increase our plan assets. Where will the 42 lakhs go? Well, it will reduce the plan assets, but at the same time, it will also reduce my plan liabilities because it is paid. Okay, the actuaries advised that the CSC, current service cost, for the year 31st March 18 was 62 lakhs. This will increase my liability. Second effect going to the profit and loss account, 62 lakhs in the profit and loss, 62 lakhs is the increase in my liability. On 20th of February 2018, the rules of the plan were amended with retrospective effect. Remember, this is not a change in assumption, this is actual change in the rules of the plan. These amendments mean that the present value of the defined benefit obligation was increased by 15 lakhs from that date. Okay, so your past service cost, this seems to be past service cost. Technically, this is adjusted on 20th February, and hence one can also say that there is an interest for 1 month. Institute does not do that. A similar sum had come in the exam where the institute had given a line that interest should not be calculated on this, and hence there was no interest calculation even if it was done on 20th February. However, keeping that interest for 1 month aside, this is past service cost. Will this increase the liability? Well, yes. Second effect goes where? OCI or PNL? Well, it goes through the PNL. The entire past service cost is to be routed through the profit and loss, which means I will take 15 lakhs increase, and the second 15 lakhs increase comes over here. During the year ended 31st March 18, A was in negotiation with employees regarding planned redundancies. Redundancies would mean reductions, like curtailments. Negotiations were completed shortly before the year end and redundancy packages were agreed. The impact of these redundancies was to reduce the present value of defined benefit obligation by 80 lakhs. Before 31st March 18, A made payments of 75 lakhs to employees affected by these redundancies. So we renegotiated some packages, and thereby we told the employees that for a liability which today is worth 80 lakhs for you, we will pay you 75 lakhs, which means if the employees agreed, we are agreeing to settle the liability for 5 lakh less, in which case what will be my journal entry? Achha, just one more thing, in compensation for curtailment of benefits, the payments were made out of the assets of the retirement benefit plan, in which case I would say liabilities account debit, this is 80, to plan assets, this is 75, but to gain on curtailment, and the gain on curtailment will go to the profit and loss. So what will I do? I will say that due to this, my liabilities are reduced, let us say by 80 lakhs. So as you can see, I am reducing the liability by 80 lakhs. But I don't pay 80 lakhs, I pay only 75 lakhs for them, and hence 5 lakhs is my gain. Gain usually goes to the credit side of PNL because this is a part of a larger EBE plan. I will reduce this gain from my overall EBE expense, and hence a minus 5 lakhs will come over here. Okay. Now on 31st March 18, the actuaries advised that the present value of defined benefit obligation was 6 crore 80. Now this is at the end of the year. And the same date, the fair value of the plan assets was 5 crore 60. Again, this is at the end of the year. So what will we do? We will take these as closing balances. This is 6 crore 80. This is 5 crore 60. Now ideally, if I do the math, this should ideally come down to 6 crore 80. However, there will be a balancing figure. This is because there is a loss due to changes in actuarial assumptions. This increases the liability, so credit the liability, debit will go to the remeasurement reserve. Similarly, there is plan assets. Ideally, if I go to see, this closing should reconcile. However, it does not, and as a result, we will say that over here we will try to find the balancing figure. This is due to changes in return on plan assets, and as a result, over here we will say that 61 lakhs is the changes in return on plan assets, but over here your plan assets will be debited because you are increasing it. So what will I credit? Remeasurement reserve. Over here your liability is increasing, so liability will be credited. What will I debit? Remeasurement reserve. And as a result, over here I will take 95 lakhs as changes on actuarial assumptions. I will debit the remeasurement reserve, and I will take negative 61 lakhs, that is credit to the remeasurement reserve, and thereby there is a net 34 lakhs, that is change in the remeasurement reserve during the year. In this question, if I were to present in the balance sheet at the end of the year, there is a 6 crore 80 liability and a 5 crore 60 asset, and hence a net deficit of 1 crore 20 will appear as a net liability. At the start of the year, 6 crore minus 5 crore 20, that is net 40 lakhs will appear as a net liability. In this case, the question has not given you data regarding asset ceiling, but even if it had given you data regarding asset ceiling, it would not matter because there is a case of deficit and not a case of surplus. Further, in this question, instead of a retirement benefit plan, you were told that this was a other long-term benefit plan. See, if nothing is given, we will assume it is a retirement benefit plan. But if it was given that it was an other long-term benefit plan, in which case, we will do the workings in the exact same way, except that there would be no remeasurement reserve. But these items would still be there. They would go into your statement of P&L. Probably because a other long-term plan is kind of usually shorter than the retirement benefit plan, and hence Institute says that rather than adjusting the OCI, we will take it directly to the PNL. This is something that you should have a fairly good understanding. This question has come in multiple times, kind of doing some or the other variation. So get this very clearly in your mind. Okay. Another question is to figure out the accounting in case of a liability. So in case of a liability, let's say there is this case where AJ is engaged in the business of trading chemicals with a net worth of 150. These first two paragraphs are just general paragraphs. If you read this, they have no connection to what is going to happen further. So this is just general paragraph, you can read them. The main question starts from here. One of the employee benefits involves a lump sum payment to employees on termination of service, which means this is to be paid at the time of retirement. That is equal to 1% of the final salary for each year of service. Consider the salary in year 1 is rupees 10,000. This is salary of year 1, not the last one salary. And is assumed to increase at 7% compounded each year. So here you have to do some working to actually find the last one salary. Taking a discount rate of 10% per year, you are required to show the benefits attributable to year on year, that is for each year of service, and the obligation, that is the liability amount in respect of the benefit, again on a year on year. For an employee who is expected to leave at the end of year 5. Okay, so we are expecting the employee to leave overall after 5 years. Currently 1 year is over, 4 years are remaining. Following assumptions are taken, no changes in actual assumptions and no adjustments needed to reflect the probability that employees might leave at a later or earlier date. So what are we supposed to do? We are supposed to find the benefit attributable to each year of service. Usually the plan formula over here is 1% of the final salary for each year of service, which means we somehow need to find the final salary. How will we find the final salary? We will say 10,000 is to be the salary for year 1, current salary for year 1. By how much is it increasing? 7%. Achha, the first increase will happen in the second year, then third year, then fourth year, then fifth year. So there will be 4 increases. Students usually take 5 increases saying that the employee will leave after 5 years. That could have been done if the salary for year 0 was given as 10,000. Here the salary for year 1 is given as 10,000 and hence subsequently there will be 4 more increases. So you will take into 1.07 raised to 4 and hence if I do this working, this is 13,108 approximately. This is an estimation of your last drawn salary, based on which you will try to find the benefit attributable to each year of service. 1% of 13,108 into each year of service, that is approximately 131 rupees. So for each year of service, the benefit that will be attributable will be 131 rupees. Now the thing is, this 131 rupees is attributable, let us say, to each year of service. However, we need to find the liability. Can I say liability will be 131 at the end of first year, then 131 plus another 131 at the end of the second year? No. 131 accrues because of first year of service, but it is not to be paid in the first year. It is to be paid at the end of the 5th year, that is 4 years away from year 1, and hence we will have to do some time value workings. So I will say that over here from year 1, your opening balance is 0. There will be no interest because the opening balance is 0, but current service cost for the first year of service 131 accrues, but this 131 is to be paid after 4 years and hence this is into 0.683. 131 into 0.683 comes to, let us say, 89. So this is approximately 89 and hence the closing will come to 89 rupees. Second, this is opening is 89. Interest on this at the rate of 10% will be 9%. Again, you have rendered 1 more year of service, which means another 131 is due, but that 131 is due, you are at the end of the second year, so it is due 3 years later. And hence you will take 0.751. And hence this comes to probably 98. If I total all of this, this comes to 196. You will keep on doing this working, like you have 89 plus 9, that is 98, that is 196. You go to the third year, 196 into 10% will come to 19.6 or approximately 20. When you go to the current service cost, we will say another 131 becomes due at the end of the third year, but this 131 is going to be paid after, let us say, 2 more years, and hence you will take into 0.8264, which will give you around 108, will give you your closing liability, and this will keep on going till the time you reach 655. What is 655? Well, 1% of 13,108 into completed years of service, that is 5 years, and this will give you around 655. So when we do this working, we will get the final answer as 655 this kind of gives you a good guidance regarding working in case you have to do for plan liabilities. Question 1 is a good question which kind of helps you for plan assets. Question 1 for plan assets and plan liabilities both disclosure. If you only want a plan asset, there was an old RTP question where we have discussed the accounting for a problem where there is expected return, actual return. I'll try to share the link over here. You can refer that. That is an only plan asset question. Question 1 is a disclosure for asset, liability, income, expense, remeasurement reserve, everything. Master question. Question 2 is only working for plan liabilities. And then if you want only a working for plan assets, there was a question that had come in RTP for which we have a separate YouTube video whose link I will share. Not very important, but if you want to refer it, you can refer that one question for plan assets. So that kind of takes care of Ind AS 19, a fairly tricky standard, but hopefully if you spend this 45 minutes well, and if you've read the content once, you should be able to kind of apply this standard if it comes in your main exams. Okay, that should be it then. Thank you very much for your time, and we will see you soon with another video. Till then, goodbye, good luck, and study well. Take care.